All right, welcome to Ryan Miller Trading Economics. This is framework part 1 of 3. This part 1 is going to be on the fundamental aspect of the framework. Part 2 will be on the technical aspect, and then part 3 will be on combining both the technical and fundamental aspects of the framework, putting them together. Okay, I'm going to try to make this as quick and as simple as possible. So let's get into it. So I'm basically a student of Eric Basmajian's work on economic cycles. When it comes to economic cycles, my opinion, right now there's no one better. I highly recommend him. I'm going to have his information, his website, YouTube channel, Twitter, below the video, the links below, so you can check them out. I highly recommend it. Okay, so when it comes to economic cycles, there's basically two sides to it. We have our secular trends and our cyclical trends. Our secular trends are the longer 3 to 5+ year trends. And our cyclical trends are our 6 to 18 month trends in the economy. So first, we're going to take a look at the secular trends. We're going to spend a couple minutes on that. Throughout my videos, we're not going to talk about the secular trends too much, those 3 to 5+ year trends, because they're not going to be as relevant to what we're doing. We're going to be focused more on the cyclical trends, which is what drives asset prices over, the shorter time frames. Like I said, 6 to 18 months. So what are asset prices going to do over the next couple quarters as opposed to, say, the next 5 years? So we're not going to, after this, we're not going to spend too much time on these secular trends. Okay, but they are important to have an understanding of, and I'll explain why in just a second. So secular trends, we can basically boil it down to two different trends: demographics and productivity. And the biggest influence on productivity is debt. Let's start with demographics. Okay. We have in the US, this is Eric's website here, and I'm going to show you some charts from his website. We have an aging demographics in the United States. Okay, if we scroll down to here, and if you look at all the major economies, Japan, US, Europe, UK, China, they all have an aging demographics. So this chart here shows 65+ year olds as a percentage of the total population. The lines are inverted, so lines going down means the population is getting older. And as you can see, in all these major economies, the populations are getting older, and they're projected to do so into 2035. And that is important because real growth over time follows demographics. This line here is demographics. As you can see, it's going down, it's inverted. That means the population is getting older, and over time, real growth follows it downwards. Sometimes it overshoots, undershoots, but over time, it follows demographics. Okay, and in the US, estimates into 2030 expect demographics to get worse, meaning the population to get older. And so we should expect throughout the rest of this decade, real growth to get weaker, to trend lower alongside of demographics. Okay. Now, we can also view this in the labor force participation rate. This is the size of the labor force. As you can see from the 1960s, labor force grew into the 1990s. And then in the 1990s, it flattened out. And then around 2000, started to roll over. And then the GFC happened, global financial crisis, it got worse. And then COVID, it got even worse. Okay, so we have an aging demographics, we have a shrinking labor force. If we have a shrinking labor force, that means we have less workers. If we have less workers, that means we have less income. If there's less income, that means there's going to be less consumption, and the private sector drives the economy. If there's less consumption, it's going to lead to weaker growth. So that's why demographics are so important. So now let's move on to debt. Total public and private debt to GDP. So this chart here shows government debt, household, business, financial, and foreign debt as a percentage of GDP. Right now, US is roughly 372% debt to GDP. Now, you can scroll down here and break this down into different sectors: total public and private, domestic non-financial, private sector, etc., etc. Now, as you can see, the debt load has gotten worse and worse over time. And it really took off in the late 80s, early 90s, which kind of starts to line up with those demographics. Now, what's significant about this is a lot of studies have showed empirically that once debt to GDP, whether you're looking at total debt to GDP or a specific sector, it doesn't really matter. But once debt to GDP hits about 90%, that 80 to 90% mark, it becomes a drag on the economy. It triggers what is called the law of diminishing returns, which basically states that every new additional dollar of debt taken on produces less and less in the real economy. Okay, so once we hit that 80 to 90% debt to GDP threshold, our debt becomes less and less productive, which weighs on the economy, which produces weaker and weaker growth. And as you can see, we crossed that barrier a long time ago, but it's gotten worse and worse. And as the debt load has gotten worse, growth has gotten weaker. 2009 through 2019 was one of the weakest growth periods in history, and that's due to these secular trends, the debt and demographics. Okay, now these don't change very frequently, right? They're 3 to 5 plus year trends. They're intact for many years, as you can see. Okay, so even fiscal monetary policies that may change these demographics or debt, it'll take years to change. So this is not something we're gonna come back to very often, but it's good to understand. And why it's good to understand is because these secular trends affect the cyclical trends, the shorter term 6 to 18 month trends. Now, like I said, the secular trends, they'll drive asset prices over long time frames, 5, 10 years. But we're more concerned with the shorter time frames. What's going to drive asset prices over the next couple of quarters, right? So we can take advantage of these moves in the market. Now, these cyclical trends is how we identify whether or I'm sorry, which direction asset prices are going to move in. Are we in a cyclical upturn, or are we in a cyclical downturn? That's important because asset prices move drastically differently, whether we're in a cyclical upturn or a downturn, meaning are we in a growth rate upturn or a growth rate downturn? Asset prices perform drastically differently. If we're in a, say, growth rate upturn, right, a cyclical upturn, stocks are going to outperform bonds. Cyclical sectors are going to outperform defensive sectors. High volatility is going to outperform low volatility. Cyclical currencies like the Aussie, the CAD, Brazilian real, etc., are going to outperform, say, the US dollar, and so on and so forth. And if we're in a cyclical downturn, well, you just kind of flip that around, right? US dollar is going to outperform, bonds will outperform stocks, US stocks will outperform international emerging markets, and so on and so forth. Now, these cyclical trends are impacted by the secular trends, okay? Now, over the last 30 years, as demographics have worsened and debt are overall indebtedness in the economy, has increased, and has had an effect on these cyclical trends. Over the last 30 years, these cyclical upturns on average have lasted only 1.1 years, whereas the cyclical downturns have lasted about 1.5 years. So those cyclical downturns, the growth slowdowns in the economy, have lasted longer than the upturns, and that's because of these secular trends, the debt and the demographics. Okay, so that's why these secular trends are so important and good to have an understanding of, because they determine basically how strong and how lasting these cyclical trends are going to be. Okay, and like I said, over the last 30 years, the cyclical downturns have been longer lasting because of these trends, and these trends are still intact and they're not going anywhere. So we should expect going forward the cyclical downturns to be longer lasting and stronger than the cyclical upturns. Now, let's move on to the cyclical upturns. What defines a cyclical upturn, right? or sorry, what defines a cyclical trend, right? Whether it's upturn, downturn. What defines a cyclical trend is we look at certain data. We look at what's called coincident data. Now, coincident data tells you where the economy is right here, right now. Okay. Now, Eric, through his work, he likes to look at or he likes to call the four corners of the economy, which are the most important aspects of the economy in determining where the economy is right now. So he calls them the four corners of the economy, which every economy has. And those four corners are income, consumption, production, and employment. Generally speaking, more income will lead to more consumption, which leads to more production, which leads to more employment, which then leads to more income and more consumption, and so on and so forth. Right? The cycle, that's the economic cycle, it reinforces itself. That would be a cyclical upturn. In a cyclical downturn, we're going to see less income lead to less consumption, lead to less production and less employment, which then leads to less income and less consumption, and so on and so forth. It reinforces itself to the downside. That would be a cyclical downturn. Okay. So like I said, we're going to look at the coincident data to determine are we in a cyclical upturn or a downturn. So we're going to look at real income, right? Adjusted for inflation, real income. We're going to be looking at real consumption. We're going to be looking at industrial production, right? We're going to be looking at employment. And as you can see, currently, those lines are all trending to the downside. We've been in a growth slowdown. We're not going to get too deep into that right now. Okay, but that determines where the economy is, these coincident indicators, right? Income, consumption, production, employment. Now, they do not lead. They are not leading indicators. They do not tell us where the economy is headed, just where the economy is. So in order to determine where the economy is headed, we need to look at leading indicators. And that's important because asset prices are going to respond accordingly to those leading indicators. Asset prices are going to price in where the future economy is headed. So if you wait for coincident indicators to make moves in the market, well, you're likely going to miss the moves, right? Because asset markets or asset prices are going to price in the future health of the economy. So if you wait for the coincident data, you're likely going to be too late. So we need to look at leading indicators. So we're going to be looking at two different types of leading indicators. Eric likes to separate them into longer leading and shorter leading. So that's what we're going to look at. Longer leading data has longer lead times, often up to a year. Shorter leading data has shorter lead times. It could be anywhere from 2 to 6 months. Okay, some of the longer, I'm not going to go through every piece of data. It would take too long. I'm just going to go through a few pieces very briefly, just what we're going to be looking at. Some longer pieces of data are going to include things like the money supply, the M2, right? This is depository accounts mostly. So if M2 is rising, that means capital is finding its way into private hands and into consumers. And since private consumption, right, the private sector drives the economy, this is an important piece of data. It's a long leading indicator. As you can see, real M2 peaked back in February 2021. It's been over a year, right? It's been over a year now. It's contracting, right? It's below zero. Okay, so that's a longer leading indicator. Another longer leading indicator are private borrowing, right? Private borrowing costs, private borrowing rates. So looking at 30-year mortgage rates, looking at corporate rates, looking at treasury rates. As you can see, since the end of 2021, rates have increased quite significantly. It's been a rapid increase in private borrowing costs. So, sorry, trying to zoom in a little bit. This is a steep incline, right? That has, and again, this is mortgage rates, this is treasury rates, this is corporate rates. So this affects every sector of the economy. This is a long leading indicator. Okay. We're also going to look at construction, like the housing sector, right? The housing sector is very cyclical. Total construction spending. Okay, we're going to look at housing plus durable goods, right? Very cyclical. Right? This is housing plus durable goods as a percentage of GDP. Okay, as you can see, if you look closely here, housing and durable goods decline as a percentage of GDP leading in to every single recession. This is a longer leading indicator. Okay, and now it's back on the decline. All right, so again, a longer leading indicator. So now once these longer leading indicators turn down or turn up, we don't just start buying and selling. They have long lead times. So what we wait for is the shorter leading data to then coincide with the longer leading data. Okay, so some things on the shorter leading side we're going to be looking at things like capital goods new orders. Okay, this is very cyclical. Capital goods, things like equipment, machinery, vehicles, right? This is very cyclical. Okay, so this is shorter leading data. Things like average weekly hours of production, right? Average weekly hours in the manufacturing sector, right? That's a leading indicator. More hours leads to more income. Less hours leads to less income. So this is a shorter leading indicator. We're going to be looking at things like the ISM manufacturing PMI. This is a shorter leading indicator. It's very cyclical. It precedes the upturns and downturns in the cyclical growth rate, in the cyclical trends. Same thing with ISM manufacturing new orders, right? Also very cyclical. It's shorter leading data. Okay, we're also going to be looking at things like the yield curve, right? You're going to be looking at a basket of cyclical currencies against the US dollar, Indian rupee, Aussie dollar, Brazilian real, South African rand, Canadian dollar, Chilean peso, Korean won. We're going to be looking at cyclical basket of currencies against the US dollar. They're trending down. That means growth is probably going to be slowing down. They're trending up. That means growth is going to be trending up. We're going to be looking at different macro ratios, looking at bonds versus stocks, bonds versus commodities, commodities versus gold, gold versus bonds, and so on and so forth, and a lot of other ratios as well. Okay, so we're going to be looking at these different ratios. So what these different ratios will do is give us kind of confirmation. Right? If we have the longer and shorter leading indicators telling us that growth is moving lower, and then we have, say, the bonds outperforming stocks, well, that's going to give us confirmation because in a downturn, bonds are going to outperform stocks. Right? So if longer leading and shorter leading data turns up, and then we see stocks outperform bonds, well, that's going to give us confirmation because in an upturn, stocks outperform bonds, and so on and so forth. That's where we're going to look at some of these ratios. Okay. So now to give you an example, or just to get a little more in depth before we end this. Now, I mentioned the longer leading data, right? It has long lead times, right? So we're going to be looking at the longer leading data as well as shorter leading data, and we're going to be looking at the growth rates. Is price or is that specific data set above the long-term trend or is it below it? In this case, as the M2, real M2 turned down, as it's still above trend, things are okay. Once it gets below trend, yeah, the long-term 10-year trend on M2 is about 6%. It crossed that mark back in October, November of 2021. That's a strong signal when it drops below trend, just like it'd be a strong signal when it gets back above trend. Okay, and so what we're going to look for is if we have longer leading data cross trend, the growth trend to say the downside, then we're going to wait for the shorter leading data to then pivot in that same direction. So let's say we're looking at ISM manufacturing PMI, right? This little fainter line here is the trend, is the growth trend. So let's say we had the M2 cross its growth rate to the downside, and then a few months later, the ISM manufacturing PMI also crossed its growth rate to the downside. Well, that's a very strong signal from an asset allocation perspective. That's going to give you a signal, okay, economy is slowing down. That's the coincident data over the next couple of quarters, right, is going to start trending lower. Okay, that gives us a signal we should start reallocating, right? I should start favoring defensive sectors over, say, cyclical sectors. Should start getting overweight defensive sectors, right? Like bonds, for instance, and underweight cyclical sectors, right? Say like the Russell 2000, right? That's if you're an investor, managing a portfolio. So that's how we're going to use that data. We're going to wait for the shorter leading data to coincide with the longer leading data, and that's a very strong signal that we should be paying attention to asset prices. Now, here, what I'm going to be doing is taking it a step further and combining what I just went over with the technicals, with the charts, okay, with these candlestick charts, which we're going to get into in part 2, okay? And the reason being is because those candlestick charts, the technical goals, are going to help us with the timing. Okay, a lot of investors, a lot of people in macro world, they look at the fundamentals. They're good at doing that. They get into certain positions and they sit in losing positions for literally months at a time because their timing is not good. And that's what the technicals are going to help us with, that timing. When is the price action? When is price in the market in line with the fundamentals? More importantly, when is it not in line with the fundamentals? The fundamentals may be saying price needs to go lower, but price may trend higher for a while. That doesn't mean we just jump in. So I'm gonna show you what we're going to look for to know when the technicals are in line with the fundamentals. That's going to give us a very high probability that, okay, this is the turning point. The technicals are now in line with the fundamentals. We're now going to get the appropriate move to the downside or to the upside, whatever the case may be. Okay, and that's where we're going to get into in part 2, the technicals. Okay, so I hope that made sense. It's just a very brief overview of how I'm going to be looking at the fundamentals. Obviously, we get more detail in the videos. Okay, if you have any questions, drop a comment. Find me on Twitter. I'm going to put a link on my website. I'll put a link. You can message me through there if you have any questions. Make sure you subscribe, and otherwise, I will see you in part number 2.